Most people think building wealth is about playing it safe. Save a little, spend less, hope for the best. But here is a hard truth that financial history keeps proving over and over again. The people who become truly wealthy are not the ones who avoid risk. They are the ones who learn how to manage it. There is a massive difference between reckless gambling with money and making calculated, informed financial decisions. The greatest investors and the richest names in the world did not get there by sitting on the sidelines. They studied risk, respected it, and then used it as a tool. And if that sounds like something only billionaires can do, stay tuned, because this video is going to change the way you think about money forever. The real meaning of risk in wealth building. Risk is one of the most misunderstood words in finance. Most people hear the word and immediately think of loss. They picture crashes, bankruptcies, and regret. But in the world of wealth building, risk is simply the cost of opportunity. Every meaningful financial gain in history has been attached to some form of uncertainty. The question is never whether risk exists, it always does. The question is whether the potential reward justifies taking it. Think about Ashton Kutcher.
For trafficking. And this refugee crisis, if we want to be serious about ending slavery, we cannot.
Tech investing, he co-founded a venture fund called A-Grade Investments. He and his partners placed early bets on startups that many investors were skeptical about, Airbnb. At the time, those were genuinely risky bets. Nobody knew whether strangers would ever trust a ride from a random driver or sleep in a stranger's home. But Kutcher and his team did not see blind risk. They saw a calculated opportunity based on changing consumer behavior. The reward that followed was extraordinary. This is what separates smart risk takers from gamblers. Gamblers make decisions based on hope. Smart investors make decisions based on research, trends, and logic. They understand that no investment is guaranteed, but they also know that staying completely idle with money is a risk in itself. Inflation quietly erodes the value of undeployed cash every single year. Doing nothing is still a financial decision, and often a costly one. Risk also exists on a spectrum. At one end, there are low-risk instruments like government bonds and high-yield savings accounts. These offer modest, predictable returns. At the other end are high-risk assets like individual startup equity or volatile commodities. The returns can be massive, but so can the losses. Most wealth building strategies live somewhere in the middle, a deliberate, balanced mix that adjusts over time depending on age, goals, and financial stability. The key insight is this: risk tolerance is not fixed. It is something that can be built, educated, and strategically expanded. How smart investors balance risk and reward. One of the most powerful principles in wealth building is diversification. It sounds simple, but most people never actually apply it. The idea is to spread money across different types of assets so that a loss in one area does not wipe out the entire portfolio. Beyoncé is a perfect example of this approach in action. Beyond her music career, she has invested in the streaming service Tidal, maintained stakes in blue chip stocks, and built a significant real estate portfolio. These assets behave very differently from one another. When one market dips, another often holds steady or climbs. That balance is not accidental. It is the result of deliberate, informed financial planning. Ellen DeGeneres has applied a similar philosophy through real estate. This real estate flipping strategy is not passive, it requires research, timing, and risk assessment. But because she repeats the process across multiple properties and markets, no single failure is devastating. The overall portfolio stays healthy. Taylor Swift has taken diversification even further by building a broad real estate footprint across multiple cities in the United States, including properties in New York, Rhode Island, and Nashville. Real estate provides a tangible, appreciating asset that balances out the volatility of other investments. It generates rental income, increases in value over time, and serves as a financial anchor when other markets get turbulent. Another critical element of balancing risk and reward is the concept of compounding. When money earns a return, and that return is reinvested rather than spent, the growth becomes exponential over time. This is not a dramatic strategy. It does not make headlines, but it is responsible for more lasting wealth creation than almost any other tool available to everyday investors. The earlier it starts, the more powerful it becomes. A person who begins reinvesting at 25 will almost always outperform someone who starts at 40, even if the late starter invests far more money overall. Time, in wealth building, is the most underrated resource. The wealthiest investors also pay close attention to the concept of asymmetric risk. This means finding situations where the potential upside is dramatically larger than the potential downside. It is not about risking everything on one outcome. It is about identifying positions where a small amount of capital, if placed correctly, can produce a return that vastly outweighs what was risked. Venture capital investments work this way. Most bets fail, but the ones that succeed, the Ubers, the Airbnbs, the early Amazon shares, can return hundreds of times the original investment. The mindset that turns risk into real wealth. Strategy alone is not enough. The people who build lasting wealth operate from a fundamentally different mindset than those who stay financially stagnant. They do not see a stock market correction as a catastrophe. They see it as a sale. They do not panic when a business struggles in its first year. They see it as a learning curve. This psychological relationship with risk is often the single biggest separator between people who accumulate wealth and people who merely earn money. There is reputational exposure, capital investment, and the very real possibility of failure in a crowded market. An underserved audience that mainstream brands had ignored for decades. They were not reckless. They were strategic. The result was a billion-dollar brand built on a calculated bet that turned out to be one of the most successful celebrity business ventures in modern history. Jessica Alba took a similar path with The Honest Company. She entered a market dominated by established giants and bet on a growing consumer demand for non-toxic, transparent household products. That was a risk, both financially and professionally, but it was a risk grounded in market research, shifting consumer values, and a clear brand identity. The company went public on the Nasdaq exchange, validating the long-term vision behind the original leap of faith. What both of these examples reveal is that the most rewarding risks are never random. They are backed by knowledge, timing, and conviction. They come from people who have educated themselves enough to recognize when an opportunity is real and when it is an illusion. Financial education is not a luxury in wealth building, it is the foundation. Every dollar invested without understanding is a dollar exposed to unnecessary danger. The truth about risk and reward is simple but rarely comfortable. Wealth does not grow in the absence of uncertainty. It grows in spite of it, and because of it. Playing it safe feels secure, but it often locks people into a cycle of incremental income and no real financial progress. The most powerful move anyone can make is to stop fearing risk and start learning how to work with it. Study the market, diversify aggressively, reinvest consistently, and most importantly, think long. Wealth built with patience, knowledge, and strategic risk is not just more durable than wealth chased with desperation. It is the only kind that truly lasts.